Welcome back to the deep dive. Today, we are unpacking a situation in the markets that feels a little bit like a roller coaster that just pulled into the station.
After a huge loop-de-loop, maybe.
Exactly. We're talking about gold, we're talking about silver, and honestly, looking at the charts this week, we're talking about gravity.
A lot of gravity.
But before we get into the shiny stuff, and there is a lot to cover, I want to mention that this deep dive is brought to you by VirPoint.
Right.
If you are looking at these markets, seeing this volatility and, seeing opportunity, VirPoint is an online CFD brokerage that lets you trade on commodities, stocks, ETFs. They're all about precision and real-time execution, which, as we are about to find out, is pretty critical right now.
Absolutely. I mean, especially given the volatility we've seen. In this environment, speed isn't a luxury, it is a necessity. If you're clicking a button, you need to know the price you see is the price you get.
Right. So let's look at the numbers because they are, frankly, startling. Gold recently tagged 5,600. Silver hit 120. Those are massive historical numbers. But now, we're cooling off. Gold is hovering around that 5,000 mark, and silver is back down around 80.
It's a significant pullback. There's no sugarcoating that.
So the mission for today isn't just to look at the scoreboard and say, wow, prices went up and then down.
Yeah.
We want to unpack the sprint to those highs. What were the consensus drivers that pushed us there? And critically, what does this current consolidation, if we can even call it that, tell us about what happens next?
That is the key question. We aren't just looking at price. We are looking at market psychology.
Yeah.
We need to understand who's holding the bag, who's buying the dip, and whether the fundamental thesis has actually changed or if the market just got ahead of itself.
And just a quick note for everyone listening, while VirPoint offers the platform to act on these movements with razor-sharp precision, what we are doing here is market commentary. This is not financial advice.
Exactly. Always do your own due diligence.
Okay, let's unpack the scoreboard. Set the scene for us. What has been the feel of the tape recently? Because looking at the charts, it just looks chaotic.
Well, if you've been watching the screens, it's been frantic. You had those record highs, followed immediately by a massive spike in volatility. It wasn't a gentle slide down.
No, it was violent.
It was violent. And now we're in a period of, let's call it digestion.
Digestion is a polite way of saying everyone is catching their breath and checking their bank accounts.
Essentially, yes. But look at the levels. Gold peaked at roughly 5,600 and is now trying to find its footing in the 5,000 zone. Silver peaked at 120 and is now consolidating around 80.
I loved the analogy in our notes about silver specifically, called silver gold's caffeinated cousin.
It is a perfect description. It really is.
Yeah.
Silver does everything gold does, but with more drama. It has bigger swings in both directions.
So when gold jogs, silver sprints.
And when gold trips, silver falls down the stairs.
Yes, that paints a vivid picture. And it brings up an important point about volatility. Why does silver act that way? Is it just because it's a smaller market?
That's a huge part of it, yes. The silver market is much less liquid than the gold market, so it takes less money to move the price significantly. That creates those wild swings.
Right.
But it's also psychological. Silver attracts a more speculative crowd. It's often the retail trader's favorite playground because the unit price is lower, so you get this amplified behavior.
It's the people's metal, but the people are panicking. So we saw this massive run-up and then this sharp drop. Why the drop? Was it just gravity taking over?
It's rarely just gravity. A peak like that isn't necessarily a prediction of the future. Think of it more as a snapshot of stress. Stress, positioning, and liquidity. The recent drop we saw, specifically those whipsaws in late January, that's largely attributed to profit taking.
People taking their chips off the table.
Exactly. And the unwinding of crowded positioning. When everyone piles into the same trade, the exit door gets very small very quickly.
Yeah. Like a crowded theater where someone yells, fire.
Or in this case, sell. Everyone rushes for the exit at once, and price collapses simply because there aren't enough buyers to absorb that sudden wave of selling.
So that's the what. Let's get into the why. Because this run-up didn't happen in a vacuum. Why did we see this explosion in price in the first place?
It's fascinating because it wasn't just one single catalyst. Usually you have one big story driving a market. Here, it was really 5 different drivers just stacking on top of each other. It was a perfect storm of tailwinds.
Okay, let's walk through them. Driver number 1, safe haven demand. This feels like the one everyone knows.
This is the classic driver. You have geopolitical risk, macro uncertainty. When the world feels unstable wars, elections, social unrest, capital looks for a bunker. It pushes money towards stores of value.
Right. When the headlines get scary, people buy gold. That's the oldest story in the book. It's fear, monetized.
It is, but it's foundational. It sets the floor. If people are scared, they aren't selling their gold. But then you layer on driver number 2, central banks.
This is the de-dollarization narrative, right? We hear this buzzword a lot. What does it actually mean in practice?
Precisely. This is a structural tailwind.
Yeah.
We are seeing the official central banks around the world, particularly in the East and Global South, buying gold aggressively. They're doing this to diversify away from U.S. dollar assets.
Why now? What triggered this shift?
Because they've seen that the dollar can be weaponized through sanctions. If you hold your reserves in dollars and you get sanctioned, your money is effectively frozen. If you hold physical gold in your own vault, nobody can freeze it. This isn't just a trade for them. It's a strategic shift in how they hold reserves. It's about sovereignty.
So you have the fear trade and you have the central bank strategy trade. What's driver number 3?
Rates and real yields.
Okay, this always confuses people. I feel like we need to do an explain, like I'm 5 here. What are real yields and why does gold care?
Great question. Simply put, gold pays you no interest. It just sits there. It doesn't write you a check every quarter. If you put money in a government bond, you get a yield, let's say 4%. But you have to subtract inflation. If inflation is 3%, your real yield is only 1%.
Okay, so that's the real return on my money, what I can actually buy with it.
Exactly. Now, markets tend to bid up gold when real yields fall. If inflation goes up and rates stay low, your real yield might turn negative. Suddenly, that non-interest-bearing gold looks much better than losing purchasing power in a bond.
And there's an element of trust here too, right?
Crucial point. It's also about uncertainty regarding monetary policy independence. If investors aren't sure what the central banks are going to do with rates, or if they think policy is becoming politicized.
Like cutting rates just to boost the economy before an election.
Right, rather than because the economy needs it. Gold becomes attractive because it can't be printed or manipulated by a central bank committee.
Okay, so we have fear, we have central banks buying for sovereignty, and we have rate uncertainty making bonds less attractive. What about the actual traders?
That brings us to driver number 4. ETF flows. We saw financial demand just re-accelerating. And the thing about ETF flows is that they can become self-reinforcing.
Momentum begets momentum.
Exactly. Price goes up, the gold ETF shows a good return on the screen, retail investors and funds see that green number and say, I want some of that. More money flows in. The fund physically has to buy more metal to back those shares. That buying pressure pushes the price up more. It's a feedback loop.
Until it stops, of course.
Until it stops. But on the way up, it's powerful.
And then we have the caffeinated cousin again. Driver number 5 seems specific to silver.
Yes. Silver rides the macro wave with gold, but it has an extra engine, the industrial narrative.
Right, because unlike gold, which mostly sits in vaults or becomes jewelry, we actually use silver to build things.
Lots of things. Solar panels, electronics, medical devices, the whole energy transition storyline. So with silver, you get the macro hedge protection against fear and inflation, but you also get a cyclical bet on technology and industry.
So, if I can summarize, gold is the macro hedge. Silver is the macro hedge plus a cyclical bet with leverage.
That's a great way to frame it. If you think the economy is going to boom and we're going to build 1 billion solar panels, silver is your play. If you think the economy is going to crash, gold is your play. Silver sits strangely in the middle of those two outcomes.
And here's where it gets really interesting for you listening. Whether your personal thesis is, I think the world is getting scarier, or I think we are going to build 1 billion solar panels, you need a way to express that view.
You do. Understanding the driver is only half the battle. You have to be able to act on it efficiently.
And that is where VirPoint comes in. We mentioned them at the top, but it's relevant here. If you understand these drivers, say you want to trade on that industrial demand for silver, or you want the safe haven status of gold. VirPoint provides a multi-asset account. It allows you to trade CFDs on these commodities, but also on ETFs and stocks.
Right.
So if your thesis covers different asset classes, maybe you want to buy silver but short a solar company, you can manage it all from one place.
And that flexibility is key when the drivers are this complex. You don't want to be jumping between 3 different apps to execute a single strategy.
Absolutely. So we had the run-up. We know why it happened, that stack of 5 drivers. Now we are in this consolidation phase. You mentioned that word earlier. Can we define that? Because to me, consolidation just sounds like nothing is happening.
It can feel that way, especially after the fireworks we just saw. But it's actually a very active time underneath the surface. Define consolidation simply as the market agreeing on a price after a massive repricing event. The market sprinted, realized it was out of breath, and now everyone is standing around asking, okay, is this the new normal? Are we really worth 5,000?
So we're at 5,000 for gold and 80 for silver. What are the scenarios here? What's the market trying to decide?
There are generally three scenarios we look for in a phase like this. The first is the bullish scenario, a healthy pause.
What does that look like?
That's where strong hands institutional investors, central banks, step in and absorb the supply coming from the people taking profits. The price dips, and someone buys it immediately. Volatility cools down, the price holds steady, and the trend survives. It's a rest stop before the next hike.
Okay, scenario.
The bearish scenario. Distribution.
That sounds ominous. Distribution.
It can be. This is where the smart money is quietly handing off their bags to the dumb money. Rallies get sold into. Every time the price tries to bounce, someone hits the sell button. Support levels start to weaken. It looks like consolidation, but underneath, the big players are exiting while the latecomers are still buying.
Then the third option.
The range regime. This happens when the macro picture stays uncertain. The buyers pause, the sellers pause, and the price just chops sideways between clear levels.
Right.
It's a waiting game. The market effectively says, I need more information before I move.
There's a psychological shift that happens here, isn't there? I read something in the notes that really stuck with me. It said that after a peak, traders stop asking, what's it worth? And start asking, who is trapped?
That is a profound shift. When you're making new highs, everyone is looking at potential value blue skies. But after a sharp drop, you have a lot of people who bought at the top. Imagine the guy who bought silver at 115. He is underwater. He is trapped.
He is praying for it to go back up just so he can get out.
Exactly. He's not looking for profit anymore. He's looking for relief. And the market knows that every time the price goes up a bit, those trapped traders might sell just to break even. That creates overhead resistance. That supply has to be chewed through before the price can go higher.
So what does this all mean for you listening, staring at a chart right now? Let's get tactical. What are the levels and tells we should be watching?
Let's break it down by metal. Start with gold.
Okay, gold watch list. What are we looking for?
The current battleground is 5,000. That's the level the market is fighting over. It's a big, round psychological number.
Humans love round numbers.
They do.
Yeah.
And the psychological reference point is that all-time high at 5,600. So 5,000 is the floor we're watching. But more than the number, look for the signal. Ask yourself, do pullbacks get bought quickly? When the price dips to 4,980, does it snap back within 10 minutes? That's bullish. It means buyers are sitting there waiting.
And what about the news cycle? You mentioned earlier that news drives fear.
That's the second signal. Is the market numb? If you see a scary headline war escalating, inflation spiking, and gold doesn't jump, that might be a sign of absorption, that the market is full and can't take any more good news. Or conversely, if bad news hits and it doesn't drop, the sellers might be exhausted.
It's like poking a bear. If it doesn't move, it might be asleep or dead.
Or it has already eaten enough, exactly.
Okay, let's look at the caffeinated cousin, silver watch list.
The battleground is 80. The blow-off high reference is 120. That 120 number hangs over the chart like a feeling right now.
And what are the signals for silver? Since it's an industrial metal, should we look at tech stocks?
Partly, yes. Silver is a risk proxy. So watch how it behaves relative to gold. Does silver outperform on up days? If the general market is rallying and silver is rallying harder than gold, that shows risk appetite is healthy. It means traders are confident.
And on the downside, what's the danger sign?
Watch for liquidity stress. We call them air pockets.
Air pockets.
Yeah.
Sounds like turbulence.
It is. Because the silver market is thin, you can see big, sudden drops during the day where the price just seems to vanish for a moment. It drops 2% in seconds. That signals that liquidity is thin. There are no buyers on the book. That's a danger sign that the structure is weak.
This is where having the right tools matters. You can't spot an air pocket if you are looking at yesterday's closing price in the newspaper.
No, you can't even spot it if your data is delayed by 15 minutes. You need real-time data. You need to see the order flow as it happens. You need to see the bid and the ask.
And this connects back to VirPoint. They offer AI-driven insights and real-time data. If you're trying to spot these tells, like whether a pullback is being bought instantly or if liquidity is drying up, you need advanced tools. VirPoint provides those to help traders manage risk, and they do it with zero hidden fees.
That transparency is crucial. When you're trading volatile assets like silver, fees and wide spreads can eat into your margins if you aren't careful. You need a broker that gets out of your way.
Exactly. So we've covered the history, the drivers, the psychology. Now comes the big question, the so what? If I'm a listener sitting here with this information, what do I actually do?
We need a decision framework. We can't tell you what to buy, but we can tell you how to think. It depends entirely on your timeline.
Let's start with the long-term view. The investor who holds for years.
If you're a long-term investor, you need to ignore the 15-minute chart. You need to go back to your original thesis. Ask yourself, does the macro uncertainty and the demand for diversification still hold?
Has the geopolitical situation improved? Have central banks stopped buying gold?
Exactly. If the answer is no, the world is still messy and central banks are still hoarding, then the thesis probably stands. The consolidation might just be noise in a longer signal. You treat this pullback as a sale price on a long-term asset.
Okay, what about the tactical view? The trader who wants to play the swings. The person watching that 80 level on silver.
For the tactical trader, consolidation is where patience gets paid. It is very tempting to try to guess the breakout. Don't. You wait for confirmation. You wait for either a continuation, a clear break above resistance, or a cleaner breakdown signal.
So don't try to be a hero in the middle of the chop.
Exactly. The middle of the range is where accounts go to die. It's just random noise. You want to trade the edges.
And we have to mention the risk. We've talked about the upside, but things can go wrong.
Always. Both metals, but especially silver, can whip violently. You can be right on the direction. You can correctly predict that silver is going to 100. But if you leverage too high, a 5% drop before the rally will wipe you out.
That's the stopped-out scenario.
Yes. Position sizing matters more than prediction. I can't stress that enough. If you bet too big, a normal market fluctuation becomes a catastrophe. Size your trade so you can survive the volatility.
That is a sobering but necessary reminder. Surviving is the prerequisite to winning, and it ties perfectly into the final call to action for VirPoint. Their mission is to empower traders. They aren't just giving you a buy button, they are giving you a platform that blends AI tools with human insight.
And critically, it's an execution-only platform.
Right. That means you, the listener, retain full control. VirPoint doesn't tell you what to do. They give you the car and the map, but you drive. If you're ready to take full control over your investment decisions, that is the kind of environment you want.
Precisely. You want the tools, but the decision and the responsibility must be yours.
So let's wrap this up. We've covered a lot of ground today.
We have.
Quick summary. Gold and silver ran hot, driven by a stack of 5 powerful drivers. They are now cooling off. The market is currently in a fierce debate between a healthy pause and a distribution phase where the smart money might be leaving.
That is the state of play.
I want to leave the listeners with a final thought. We usually end with something provocative. What's sticking out to you in this market?
You know, in a consolidation phase like this, silence is often louder than noise. We're so used to reacting to breaking news, checking our phones every 5 seconds. But right now, if the headlines are screaming war, inflation, politics, but the price isn't moving, the market might have already made up its mind.
It might have already priced all that in.
It might have.
Yeah.
So the question for you listening is, are you listening to the news or are you listening to the price action? Because right now, they might be telling 2 very different stories. The news is loud, the price is quiet. Trust the price.
That is a great perspective. Sometimes the lack of a reaction is the biggest reaction at all.
It really is.
Well, on that note, we are going to sign off. Thank you for diving deep with us today. A huge thank you to VirPoint for making this possible. Remember to check out their platform if you are looking for commission-free trading on stocks, ETFs, and commodities. Their slogan is master the markets and own the moment. And honestly, in a market this volatile, you need to own every moment you can get.
Absolutely. Trade safe, everyone. Watch your sizing.
See you next time on The Deep Dive.